Full screen is not there, madam.
Hello, are you able to hear me? Hello? Hello?
Good evening.
You are able to hear me, sir?
Yes, yes.
Okay, okay. So whether my screen is visible?
Yes, ma'am. Screen is
visible.
visible.
Okay, so good evening all. I think last few classes we were continuously on the GST part. Just for a change, this week we will see about the valuation and baggage related. So if you see the customs area, we have valuation and RPT and baggage, manufacture inbound duty drawback and customs rules, remission, refund and facilitation measures and export promotion schemes and special economic zone scheme. So we have 30% of the marks from customs related. So today we will see about valuation part. So we under this valuation we are going to see what is valuation and how we are going to do the valuation for the export goods under as well as under imported goods rules. So this is for the customs. So whenever we export the goods or whenever we import the goods, so how we are going to calculate the duty and how we go for refund, those things will be discussing in this chapter. At what point of time we have to claim for the duty, or what is the duty percentage, and whether what is mean by the assessable value, FOB, those things we will be seeing here. So now I will move on to my next slide. So in this valuation, first thing we need to understand is the transaction value. So what is meant by transaction value? So it is as per the Customs Tariff Act or any other law for the time being in force, the value of imported goods and export goods shall be the transaction value. Here they just mentioned the value of imported goods and the export goods. So what does that value means? That value only we are going to see in this subsequently. So what is the transaction value for the export goods means, and what is the transaction value for imported goods means? So what items we need to consider? So the price actually paid or payable for the goods. In case of
Madam, slide is not moving. Slide is not moving.
so
Static.
now sir,
Static slide. No, no, it is not moving. I will send the picture.
yes, whether you are able to see, sir, I am in the first slide, section B, Customs Act and Rules.
I have sent you picture, ma'am.
Okay.
This only that institute some picture is there that we can see.
So the I
This
am
one only. It is not moving from here.
okay. So others, Jayashree, Anu, are you able to see? The I am moving the slide actually. Whether you both of
Yes,
you.
ma'am. Yes, ma'am. Slides are visible.
Okay.
Yeah.
Ekman sir, please try once again with a different connection, sir. Once.
Okay, ma'am.
Yeah. Yes. Yes, sir.
I will rejoin.
Please, please. Okay. So here what is mean by the transaction value in case of export goods, and what is mean by the transaction value in case of imported goods. So in case of export goods, transaction value means the price actually paid or payable for the goods when sold for export from India. So this is for the, suppose when we are selling the goods from India. So when sold for export. Hello, those who are in call, you are telling me something.
No, no,
Hello.
it is visible now, ma'am.
Okay,
Yes.
sir. So when sold for export from India for delivery at the time and place of exportation, where the buyer and the seller are not related. So again, in GST also we have seen who are called related persons. So the term related is very important. So where the buyer and the seller of the goods are not related, price is the sole consideration for the sale. It's like a what are the conditions or the basic criteria we can see. So in case of export goods, these are the basic things, and in case of imported goods, so what are the conditions should be? What does transaction value mean? The price actually paid or payable when sold for export to India and for delivery at the time and place of importation. That is also important. Where is the place of the point we can say, and where the buyer and seller are not related and price is the sole consideration for the sale. So these are the, whenever we calculate the transaction value. So why this transaction value is important? Because based on this transaction value only we are going to arrive our customs duty payable. So what are the items we need to add and what are the items we should not consider, those things based on this transaction value only we are going to calculate. So the transaction value is very important either in case of export or import purpose. Valuation for export goods. So why this valuation is important? It is essential even though many products are exempted from export duty. So the importance is for valuation is duty drawback, export incentives like DEP DEPP license, and a refund of Senvat credit if any, payment of duty on export. So these items are there, like a duty drawback, export incentives, refund of Senvat credit. So actually this refund of Senvat credit was there prior. Now post GST we need to see for the GST terms only. Then payment of duty on export if any. So these are the valuation for purpose why we are going to do the valuation. So because based on this valuation we have several essential things are there, like how much duty drawback we can apply and we can claim, and export incentives, like suppose there are like a road tax, so many schemes, incentive schemes are there. So based on that we are going to claim. So for this purpose we need the valuation for export goods. Then customs valuation is applicable. Okay. Then we are going to see about the valuation rules for exports. So what are the methods are there for valuation? So last 2-3 slides we have seen only what is mean by the transaction value. So what does the transaction value mean for export, what does the transaction value mean for import, and why this valuation is essential. Then under this valuation, importance of valuation, we are seeing about the duty drawback. So these points we are going to see in detail in our duty drawback chapter, that is 21st that chapter. So we are having the duty drawback in detail. So now we are going into the valuation rules for exports. So what is the valuation rules, and it has come into force the 10th October 2007, and they shall apply to all the export goods. So there are important definitions: goods of like, kind and quality, and what is the transaction value. So these goods of like, kind and quality, we have we call it as an identical or similar in physical characteristics. So if I tell you directly those definitions, you may you may understand like 1 to 2%. So what exactly this identical or similar in physical characteristics? If you look into the subsequent problems, so where we are applying those things, so you will get a good understanding about these definitions. Goods of like, kind and quality. So goods of like, kind and quality means, suppose I am exporting the goods, and here it has been received by the Mumbai harbor, and they want to put some duty. So on what? There is no assessable value, it's not mentioned over there. In that case, on what basis they consider the duty amount? So the goods which are identical or similar. So for example, I am in US and I am sending some mobile phones through harbor, that is through ship. So it has been reached Mumbai port. So now the customs officer, they don't have the how to calculate the duty amount. So what they do, so the similar type of mobile, if has been arrived in the port earlier, they go and check all those details, and the similar, that is identical or similar in physical characteristics, the same value they consider for the mobile which I have already shipped. On that amount only they calculate the duty. So these things, when you go still come across other problems and all, you will have a good understanding. So now it is like a definitions only, that export goods which are identical or similar in characteristics, quality and reputation, as the goods being valued and perform the same functions or commercially interchangeable with the goods being valued produced by the same person or a different person. Then determination of the method of valuation. So the value of export goods shall be the transaction value. The transaction value shall be accepted even where the buyer and seller are related, provided the relationship has not influenced the price. So these are very important, and for even actually this topic is valuation and related party transactions. So this particular line, that para 2, the transaction value shall be accepted even where the buyer and seller are related, provided that the relationship has not influenced the price. So I have my company in US, and out of that 30% or 50%, for example 30% of the shares are held up by a company which is located in Maharashtra. So in I will say in a different way, say for example I am here in Maharashtra, and one of my partner subsidiary company is in US, which are holding 30% of shares in my company. So now I am going to sell a product, ABC product. So the ABC product cost which I am selling locally within Maharashtra is 100 rupees. The same 100 rupees only I should sell it to to a US company, which is a subsidiary company also. So this is the term here, provided that the relationship has not influenced the price. So because of some relation, or they are my subsidiary, so one of my shareholder, they are controlling my company, the third party controls. If these relations are there, I should not sell for a lesser value. Here internally I am selling it for 100 rupees, and out of India I should not sell it to the 50 rupees, 30 rupees. So these are called the determination of the method of valuation. If the value cannot be determined, the value should be determined by proceeding sequentially through rule 4 to 6. So if we are not able to determine with the previous rules, then we should go with the rules 4 to 6. So what does 4 to 6 rules says? So determination of export value by comparison, computed value method, and we have residual value method. So what is said in export value by comparison? The value of export goods based on the transaction value of goods like kind and quality exported or about the same time to other buyers in the same destination country, or in its absence another destination country of importation. So as I said earlier, so we should see the value, how much has been sold in this country, or how is this the same price I considered if I am selling it to country Y. So how it is calculated, and it should be compared. So this has been under as per rule 4. So what is the difference in the date of exportation, commercial levels and quantity levels, composition, and the domestic freight and insurance charges. So this has been covered under Rule 4. So again we will be seeing this Rule 4 while computing the problems. Then we have Rule 5, which is computed value method, which shall include the cost of production, manufacture or processing of export goods, for changes for the design or brand, any amount towards profit. And we have residual method. So the export goods, the value cannot be determined under the provisions, shall be determined using reasonable means. So even in GST also we have seen residuary clause. So what is that residuary? So in the above said rules or in sections, if it not covered, then we should go with the reasonable means, with the guidance or with the recommendations of the officers. So same here, the residual method as well. Then the declaration by the exporter. So we have to declare the value of export goods. Then we have rejection of the declared value. So what is rejection of the declared value? When the officer has reason to doubt truth or accuracy of the value declared in relation to any export goods. So they suspect on any of the value, then he may ask the exporter to furnish further information including documents or other evidence. For or in the absence of response, the officer still has reasonable doubt about the truth or accuracy, the transaction shall be deemed have not been determined. So then at the request of the exporter, the proper officer intimate the exporter in writing for doubting the truth or accuracy of the value declared. So there are two things. So suppose I want to export. So I am submitting my documents in the Mumbai harbor. So I'm going to export some product which is ABCD. So then in that, on submission of my documents, if they have any query, then it is my responsibility to submit to share the supporting documents. So the supporting documents what the customs officer they are asking, so I need to submit those documents. So till such time they will not determine the transaction value. So the same way, if I have not given on time, then they give in writing also that these documents are pending. Till the time I submit those documents, the transaction value shall not be determined. So the rejection of the declared value it is. So how they value? So main thing which we need to understand or the summary, so you can get, so we have seen rule 1 to 8. So there are some definitions, method of valuation, so export value by comparison, computed value method, and we have seen residual, the declaration by the exporter, and the rejection of declared value. So why we have seen, so if I give in a short summary what we need to understand. So tomorrow if I am going to run an export business, first thing is what? The price. The price should be what? If I am going to sell that product here, for example a mobile within Maharashtra for 10,000 rupees, am I going to sell the same 10,000 rupees while exporting the same product? So why there is a doubt? Because if my subsidiary company is there in US, to reduce my duty amount, I may sell it for 5,000 rupees. So these type of issues should not be there. So it should not influence, because of the related party, it should not influence the price. And the main thing, that should not affect our customs as well. So if I reduce my price, then I have to pay very less amount of duty. These things are there. And the residual amount method means, if we are not able to arrive the transaction value, then we should go with the guidance. Then declaration by the exporter. The last one is rejection of the declared value. And a refund of export duty. So refund of export duty, under what circumstances or within what time limit goods are actually here few points are there in the customs duty. In the chapter duty drawback, we have it in a detailed manner. So here refund of export duty, the refund of export duty is permissible. So under what circumstances it is permissible? Goods are imported within 1 year from the goods are re-imported within 1 year from the date of export. So I have exported all my products, say some 25,000 mobiles from my factory which is in Maharashtra, I have exported. So because of some issue, the goods has been from the date of export. So the goods has been re-imported within 1 year from the date of export. So again, if it is if you want to claim for the refund of export duty, then this should happen within a period of 1 year. And these goods are not for resale. We should clearly mention this is not for resale, and this has we are bringing it back just for some repair purpose or some rework purpose. Refund claim, it should be lodged within 6 months from the date of clearance by the customs officer. So the any refund, if we are applying it for, and that should have been cleared within a period of 6 months. So these are some general points in the middle we have, but in detail in the duty drawback chapter we have to see. So here still we have the few points, because before we start with the problems, we can have a discussion on this. What is meant by X factory price, and what do we call it as a free alongside, and what is FOB? Because in this valuation, all the examples, if you see, it is all related to free on board. FOB price, we are going to export, we are going to import the goods on FOB value. So what does mean by FOB? So FOB means, before FOB we should understand what is X factory price and free FAS, free alongside. So what is X factory price? Price of goods at the factory gate. It includes cost of production and manufacturer's margin of profit without freight cost for outward delivery of goods. Means I have manufactured the goods, everything is ready for shipment, and it is in the front of my factory gate. So what cost it is currently, at what cost it is? It is with the cost of production plus manufacturer's margin, my margin plus my cost of production. So that we call it as an X factory price. So X factory price is how much money I incurred to manufacture that particular product plus my profit. So that we call it as a X factory price. So then what is FAS? Free alongside. So what is free alongside? Cost at which export goods are delivered by the seller to the port of shipment but not on board. So till Mumbai harbor, but I have not shipped it. It is till the Mumbai harbor. That's all. The buyer assumes cost and risk from that point onwards, including loading the goods onto the ship. So my another subsidiary company is in say for example it's in US, then what is their risk, their liability starts, they assumes, the buyer assumes the cost and the risk from the point, so from which point, from the port, Mumbai port, till from the beginning of, like my shipment is only till Mumbai harbor, but when we the same goods are loaded onto the ship, so from that point it starts, the risk starts, including loading the goods onto ship. The buyer assumes the cost and the risk from the point onwards, including loading the goods onto the ship, plus transit freight and insurance, further transportation. This all we call it as a free alongside. That is X factory price, local freight and the local taxes. So these all prices cost we call it as a free alongside. Then FOB. So this is our major one, FOB, free on board. Stage at which goods are placed on the board vessel at the port of shipment. So stage at which goods are placed on the board vessel at the port of shipment. Once the goods are on board, the buyer assumes responsibility, freight, insurance and other cost related to the transportation, that is free alongside plus loading charges plus export duty or cess. These all included in the free on board, FOB, that is goods are placed on the board vessel at the port of shipment. So once it is ready, everything, that is it includes the loading charges plus export duty, free alongside, just we have seen what are the cost it includes. Then CIF. So what is CIF means? It is the cost goods are delivered at the Indian port. It includes FOB, insurance and freight. These all three costs we call it as a CIF. So from the term itself we know it, cost, insurance and freight here. So here few things which we need to understand is conversion dates and currency conversion rate. So which date we need to consider and what is the meant by currency conversion rate. So conversion date means for the purpose of import, the conversion to rupees, that is the rate of exchange prevalent on the date of filing bill of entry. So in case of export goods, the conversion value means rate of exchange prevalent on the date of filing shipping bill or bill of export. So these two things we need to see. So in the problems again we will see where which date we need to consider. And the currency conversion rate, there we will be seeing multiple exchange rates. So which exchange rate we need to consider while calculating our duty amount. So here what are the exchange rate we generally see? The rate of exchange notified by three agencies: Central Board of Direct Taxes and Customs, RBI, the Reserve Bank of India, and the Foreign Exchange Dealers Association of India. So the rate of exchange means which is determined by the board or ascertained as the board may direct. So we should also be careful in selecting the conversion date and the conversion rate. So we'll start with the problem, so you will come to know where and which rate we need to consider here. So we'll start with this illustration. Before that, you will be seeing there is a LET export order. So LET export order means what? It is a document that allows export of goods from India. That is the final step in the export process, and it is issued by the customs. So LET export order is the final step in the export process. So there once they give the permission or once they signed this document, then we are ready to move from that harbor. So here we will start with illustration, then we'll see where we are stuck. It is only just to understand the date and the which rate we have to consider. So I am in our study material only. Mrs. SP Limited has exported some goods to Mexico by air. The FOB price is $1 lakh. So they have exported some goods to Mexico by air and the exported value is $1 lakh. Compute the value of exported goods and export duty payable. So how we are going to compute this value of exported goods and how much duty we need to pay. So there as we have seen, there will be multiple so today we have been shipped. So from there, after multiple approvals and these things, when it going to export, so when we are submitting the document, when actual shipment is going to happen, so there are multiple things are there. So which date and which exchange rate we are going to consider here is important. Choosing is important here. So you can see presentation of shipping bill, then below LET export order. Then we have our date 17th June and the LET export order. So LET export order is finally we got a approval, that is we are ready for our shipment. And basic customs duty. So basic customs duty at the time of presentation of shipping bill it is 12 and at the time of LET export order it is 10%. Then the exchange rate declared by the CBIC and the exchange rate declared by RBI. So which exchange rate we need to consider also very important. So by the CBIC or by the RBI, that is important here. So now how we have these data, but what is the duty amount we are going to pay to the department? So we know it, our goods value, export goods value is 1 lakh. So based on this 1 lakh, how much duty we are going to pay? How we are going to calculate it? So our first thing is FOB value 1 lakh US dollar, and which exchange rate we have to consider is very important. That is the exchange rate declared by CBIC. That is very important. So that exchange rate we need to consider. So second thing, which duty, customs duty rate we need to consider. So presentation of shipping bill or the LET export order. So the generally this is going to be our final process. So the last date, or we can call as the latest date which we have the customs duty. So it is LET export order which happened on the 19th of June. On that day the customs duty is 10%. So 75 lakh on that 10 percentage BCD, which is 7,50,000. So this is the amount we need to pay to the department, export duty amount. So in this, what it is mentioned, so the transaction value, FOB price of export goods is considered as assessable value. So many times we might have come across the term assessable value in multiple our transactions also. So what is assessable value? It's nothing but our FOB price of export goods. Second one, the assessable value has to be calculated rate of exchange notified by the CBIC on date of presentation of shipping bill of export. So you can consider the exchange rate declared by the CBIC. So there are two things while considering the exchange rate. Which exchange rate you consider? It is presentation of shipping bill and not the let export order. So that is also given in our rules. That is, assessable value has to be calculated with reference to rate of exchange notified by CBIC on date of presentation of shipping bill of export. Then third one is the rate of duty, that is let export order considered for computing the export duty. And last one is, in case of export duty, exporter is liable to pay only BCD and not other duties or cesses are not applicable. So in case of the export duty, only we are liable to pay the BCD, which is 10 percentage, and we are not liable to pay any other duties or cess. So these are the basic conditions and the basic things which we will be taking to other problems solving also. So what is the major one we should remember here is which exchange rate we should consider. So the exchange rate declared by Central Board of Excise and Customs. So we know it is by the Central Board of Excise and Customs, but which whether it is presentation of shipping bill or whether it is LET export order, there again we might get confusion. It is always presentation of shipping bill. Number two is customs duty rate. So which duty rate we should consider? It is LET export order, which is the latest one. That is the rate of duty prevalent on the date of LET export order considered for computing the export duty. So there are two major things while deriving the or computing the export duty. Date is important, rate is important, and exchange rate is important. I am saying the first one is date is important, and whether it is presentation of shipping bill or LET export order, that is also important. Then the exchange rate. So always remember exchange rate to be declared by the CBIC. So now we will go with other conditions also we have. So multiple are there. We will go with the other conditions. And before that we have, like we have seen rule 8, rule 1 to rule 8 for valuation of export goods. Now we have valuation of imported goods. So now now I am doing both the business. One, I am exporting, and number two, I am importing. So how at the time of import, what are the things I need to follow, or what are the rules prescribed by the Customs Duty Act? So that we are going to see now. So I am sharing my other screen from our study material only. So once my screen is visible, please let me know.
Yes, ma'am.
Yeah. So these are the things, the same only we have been discussing, so that will not miss any nothing from the book. So we have been discussing this refund, and this is the first example. And next one is the valuation of imported goods. So now I am doing my import business as well. So for that, what are the things which I need to consider? So this has been given in the determination of value of imported goods rules 2007. So we have the again we have the same definitions: computed value, deductive value, goods of the same class, identical goods, place of importation. So what is place of importation? Customs station. Goods are brought for being cleared for home consumption or for being removed for deposit in a warehouse. So what I ordered for from US, that has been received in the Mumbai port. So that is the customs station. The goods has been brought. So now I have to clear that. So that is it's my opinion whether I can keep it in the warehouse itself or taken to the factory premises. So the goods are brought for being cleared for home consumption or for being removed for deposit it in a warehouse. So I may request the customs officer also, like they can hold it for some for 2-3 days, uh, 2-3 days. Once after some 3 days later, I can come and again go to the harbor and I can give the clearance. So it will be get deposit in their warehouse also. And produced includes grown, manufactured and mined, similar goods. These are the definitions are there. Similar goods. So the previously what we have seen, the identical or the similar goods. So here also the similar goods means imported goods, although not alike in all respects, but like characteristics and like component materials, perform same functions and to be commercially interchangeably with the goods being valued, produced in the country in which goods being valued were produced, and produced by the same person. So these are the definitions for the similar goods. Then again transaction value we have. So the very important topic again here is the related. Related means legally recognized, employer, employee, director or indirectly owns or controls, both of them directly or indirectly controlled by a third person, members of the same family. So these are the definitions for the related. Then now we are going into the problem. So we have seen about the related in like related definition. So for to get a good understanding on that what is related means. So XYZ Limited imported certain goods $20 per unit from an exporter who was holding 30% equity in the share capital of the importer company. Subsequently, the assessee entered into an agreement with same exporter to import the said goods in bulk at $14 per unit. When imports at the reduced price were effected pursuant to this agreement, the department rejected the transaction values. So if you see this, the assessee entered into an agreement with the same exporter to import the goods in bulk at $14 per unit. So bulk means what? Suppose previously I have ordered for some 10 pieces, 20 pieces, Now I need some 100 pieces or 1000 pieces. So if I increase my quantity, they may reduce the price as well. So same, the assessee also has followed it. The assessee entered into an agreement with the same exporter to import the said goods in bulk at US dollar 14 per unit. When imports at reduced price, when import at the reduced price were effected pursuant to this agreement, the department rejected the transaction values, taking that the price was influenced by the relationship, and completed the assessment on the basis of transaction value, that is US dollar 20 per unit. So I had an agreement with the import supplier who is in who is in US. So initially we have agreed $20. Later, when I increased the quantity, they have agreed it for $14. Now actually the shipment also has started, and the department calculated the value based on the $20, and they they have told it is because of the related party you have reduced that amount from 20 to 14, but I have to make payment on the $20 and not on $14. So here the question is whether the department's action is sustainable in law with reference to the decided cases. So whether it is correct. So how do we present in our examination? So person means person shall be deemed to be related. So when we call it as a related person, one of them directly or indirectly controls the other. Control, there is no set definition, but control here is control as a layman language. It says who holds more than 51% of the equity shareholding, that we call it as a control. In this case, the exporter company, they held only 30% of the shareholding. That has been given in the question itself, who was holding 30% equity in the share capital. In our case, 30% of shareholding. The exporter company did not exercise a control over the assessee. So the exporter company, they have not exercise. So that we cannot said to be related. The fact is bulk imports could be a reason for reduction of import price. The burden to prove undervaluation lies on the revenue, and in the absence of any evidence from the department to prove undervaluation, the price declared by the assessee is acceptable and the departmental action is not sustainable. So why there is a reduction in the price? Because of the bulk reduction, quantity purchase, that may be the reason. So the department action is not sustainable. So they don't have anything to prove actually. So there is their action in this particular case is not sustainable. So in this way we can present it. In this initial case, the exporter company held only 30% of the shareholding, and the exporter company did not exercise a control over the assessee, and the two parties, we cannot be said as a related party. So these three main things we need to understand from this related party definition. And that's why even in GST also we have seen who are called the related persons. So what is the percentage? So these things we need to understand. So there is a 30%, the exporter company held only 30%, and the two parties cannot be said as a related party. And the fact is the bulk imports could be a reason for the reduction of the import price. So the departmental action, it is not sustainable in law. So this way we can present it. This is just for our understanding about the related person meaning here. So the next one is rule 3. So what is defined in rule 3? The value of imported goods shall be the transaction value. So what is meant by the transaction value? No restrictions as to the disposition or use of the goods by the buyer. The sale or the price not subject to some conditions. No part of the proceeds, resale, disposal or use of the goods. The buyer and the seller are not related. Where the buyer and seller are related, the transaction value is acceptable for customs purposes. Rule 3 subsection 3. So even if they are related, there we should have proper or the supporting documents or evidence to prove that the price is not influenced due to the relationship. So one more case law is there relating to this, that is Commissioner of Customs Visakhapatnam versus Agarwal Industries Limited. So the case is the importer entered into a contract for supply of crude sunflower seed oil, metric 435, cost insurance freight per metric ton. Under the contract, the consignment was to be shipped in the month of July 2011. The period extended by mutual agreement that was shipped on 5th August. The international prices gone up due to volatility in the market, and the other imports during the August were at higher prices. So this is a good case law. So when they agreed, that time the price was less, and due to the market condition the price got increased. So the department sought to increase the assessable value on the basis of higher prices. So they don't want to lose the duty amount, so they have wanted to increase the assessable value, whether their contention is correct. And here again it is not correct. The commodity involved had volatile fluctuations in its price in the international market, and the supplier did not increase the price even after the price in its increase in the price in international market. There was no allegation of supplier and importer being in collision. So this case law is given just to understand why this valuation of export or the valuation of import goods, the topic is very important. So tomorrow when we are doing any import or when we are giving any advice to our clients, so what should be what is the price to be considered if we have paid excess duty amount? So how we can apply for the refund? So what is the exact interpretation or the justification we need to analyze? So in the case of market conditions, if there is a plus or minus in the price, so even because the department also, the customs officers also, they don't want to reduce their collection in the duty amount. So they always see if there is an increase in the market price, then they will increase the assessable value as well. So in those situations, we should be that is, we as a professional, we should be understanding the entire things, and we should justify that our intention or the contention is right. So the next one is assessable value of imported goods. So this is like, what are the items we need to add and what are the items we should not consider while calculating the assessable value of imported goods. So what is mean by assessable value of imported goods? It is FOB, insurance, freight. So FOB, insurance and freight, free on board, insurance and freight. So the statement showing computation of assessable value for imported goods. This is the for all the problems in the from valuation, we have to mention the, based on the question, statement showing computation of assessable value for imported goods. So what is the value of material? So we have seen what is the X factory price, the same. So X factory price means what? What is the cost of production I manufactured this particular product plus my profit, that we call it as an X factory price. So on the X factory price we need to add carriage, insurance, freight in the exporter's country and the charges for loading in the exporter's country. So why I am highlighting this? So we have freight, insurance or the loading charges is in the other problems. So you should not get confused which export or insurance or which loading charges. So it is in the exporter's country, then free on board. Then next one is, what are the things we need to add? Commission and brokerage except buying commission, packing cost except cost of durable and returnable packing, cost of engineering development and plan undertaken outside India, then royalties and license fees, value of subsequent resale if payable to foreign supplier, value of material supplied by the buyer free of cost. So these are the items we need to consider while calculating the assessable value. Then we post we add all these packing cost, commission and brokerage, royalties, we derive FOB value as per customs. So the cost of freight. So this very important clause here, cost of freight if not specified 20% of FOB, ship demurrage charges on chartered vessels, lighterage or barge charges, then insurance 1.125% of FOB value. Then finally we derive the CIF, which is assessable value. So assessable value is cost, insurance and freight. We call it as an assessable value. So this rule is very important one, the rule 10.1. This based on this only, this valuation chapter's whole problem depends on this rule, particular rule only. So again below we have what are the items we are not considering. So the buying commission we don't consider. Why buying commission we don't consider? Because it is a fees paid by importer to his agent. So I got a communication from one of my import supplier. The goods has already been shipped and it has reached our port as well. So instead of I go and clear the material directly, I am sending the agent. So he is called a buying agent. Buying commission means fees paid by an importer to his agent for the service of representing him abroad in the purchase of goods being valued. So if I pay the whatever commission I pay to my agent for clearing the imported goods, those should not be considered while calculating the assessable value. So here we are seeing what are the items, what are the number of the items which we have to consider while calculating the assessable value. Then buying commission, why we should not consider? It is instead of I go and clear, my agent has gone and clearing the shipment, so I am paying some commission to him. It should not be part of my assessable value. Say for example the CIF comes to 100 rupees and I am paying commission of some 20 rupees, then on 120 my duty amount should not be there. It should be 100. Buying commission, it is not part of the assessable value. Then next one is any expenditure right to reproduce the imported goods in India shall not be added. If importer imports software and pays license fee with permission to use its copies at various branches, making additional copies for its own use at various branches, it does not mean it is called reproduction. Right to use countrywide is not right to reproduce. The whole license fee is includable in assessable value. So any expenditure, so that is like the reproduce the imported goods, that shall not be added. Then here the important thing as we seen, the cost of freight insurance. So here the cost of freight is what? If it exceeds 20% of FOB, only at the rate of 20% FOB will be added for customs valuation. The cost of transport within India is not to be included in the assessable value. Then apportioning cost of tools not consumed immediately by the importer. So the cost of tools are not consumed immediately by the importer. He may request to apportion the full cost of tooling on first consignment itself. So what is that apportioning cost of tools? The cost of tooling is 2 lakhs and the tool expected to produce 20,000 pieces and the importer imports 2,000 pieces in the first lot. 10% of cost of such tooling, that is 20,000, may be apportioned to the 2,000 pieces and the 20,000 included to the transaction value. So what is that tool generally means? So the tool is, with the help of some particular tool, I can develop or I can use it for the 20,000 pieces. So instead of so in the first lot I am importing some 10%, so in the second lot some other percentage of pieces I am getting. So instead of that, what I am doing is the 20,000 apportion among the 2,000 pieces and may be added to the transaction value for the assessable value calculation purpose. Then the cost of transport of imported goods. So the ship demurrage charges on chartered vessels, lighterage or barge charges. So the ship is not brought up to jetty because deep drought at a port or ports are very busy or odd dimensional or heavy lift. These are the bringing goods from outer anchorage to the jetty called barging or lighterage charges. So what is it? Because yeah, all the ship never reach to the that is to the port directly. It will be stopped in the middle because of the heavy shipment, or due to the harbor most of the ships are parked, there is no place. In that case, whatever the charges which are paid, that we call it as a lighterage charges. So that charges, it should be include, that is cost of transport of imported goods. It should include the ship demurrage on chartered vessels, lighterage or the barge charges. But the demurrage charges for delay in clearing the goods, it is not to be added in the transaction value. So what charges we we should consider, that is barge or the lighterage charges. The demurrage charges, which is for delay in clearing the goods, that is not to be added in the transaction value. So then we have free on board, then we have the exchange rate. So now to summarize what we have seen is, we have seen about the valuation of exported goods, and we are seeing now valuation of import goods. So how we are going to value the import goods? Based on the assessable value. So assessable value means free on board plus insurance plus freight. So what are the items we consider? The FOB as per customs, and the last one is we are deriving cost plus insurance plus freight. FOB as per customs, once we derive it, we have to calculate the freight and the insurance portion. So how we are going to calculate the freight and insurance, that we are coming now. Now in this portion also exchange rate. So exchange rate, which exchange rate we need to consider? There are exchange rate of CBEC, and there is more than one exchange rate of CBEC. So even from the same Central Board of Excise and Customs, we have multiple exchange rates. So out of that, which exchange rate we are going to consider is exchange of Central Board of Excise and Customs on the date of submission of bill of entry. So this is very important. So with the previous problem, we have seen the presentation of shipping bill, same date of submission of the bill of entry. The customs duty, we have multiple customs duty. So which customs duty we need to consider? Rate of duty at the date of submission of bill of entry, or the time of entry inwarded towards granted to the vessel. So whichever date is later, so then the rate of BCD prevailed on that date is applicable. So like exchange rate, we have in so many places: shipping bill, let export order, while preparing any customs document. So multiple dates we have, and exchange rate also we have. Basic customs duty also we have different rates at the date of submission of bill of entry, at the time of entry inwards granted to the vessel. So whichever date is later, that date we should consider. Then we have freight. So freight is very important. So we have various modes of freight: air freight, sea freight are there. So now air freight means if we are importing the goods by means of air freight, yes, then what is the actual air freight we should see. Then what is the 20% off on FOB? So whichever is less, that we need to consider. So this is the first condition. You are importing through air freight. So we should see what is the actual air freight and what is the 20% on FOB. Out of that, whichever is less, that we have to consider. Second thing, if not through air freight, so what does the other mode? Sea mode. So if we are going to send the shipment through sea, yes, then we should see actual sea freight. Then even in the sea freight also we should see what is that 20%. If the sea freight is given, you need to directly take the actual sea freight. If the sea freight amount is not given in the problem, you should need to calculate manually 20% on FOB. So in the problem, if freight is not given, it doesn't mean you should not consider. If the freight is not given, then you have to consider manually 20% on FOB. Then service charges paid to canalizing agent. So who is the canalizing agent? Not an agent of the importer, he represents the importer abroad. So by purchasing from the foreign seller and the subsequent sale to the Indian importer, he is an agent who directly purchase, and we don't want to involve, he purchase and he delivers to the Indian importer. So we have inspection charges. So inspection charges are which charges on the inspection charges, what we exactly need to consider? Certification by independent agency for imported goods. So if it is there, then include into the assessable value. If not, if there is no such inspection charges which is not there, then you don't want to consider in the assessable value. So what are the items we should consider while calculating the assessable value? Why it is important? Because based on the assessable value, you are going to derive the duty amount, and the duty amount you need to pay to the customs department. So that's the reason the valuation is important. In this valuation, we are seeing what is the value, how we are going to determine the value of imported goods. Tomorrow, suppose if you get a chance to go through any bill of entry of your company or any organization where you are working, so under assessable value, what are the items it has been considered while calculating the duty amount? You can check for the freight insurance, whether freight insurance, rate of customs duty, which exchange rate they have considered. Those things you can have a look in your organization, which will give more idea and more confident as also. So what we are seeing exactly here, the same only will be followed in your bill of entry. So number 2 is, there is one more case law regarding the demurrage charges. So it is a case law for between Commissioner of Central Excise Mangalore versus Mangalore Refinery and Petrochemicals Limited. Revenue contended, demurrage charges paid by the assessee are includable in the assessable value for the levy of customs duty. So the demurrage charges are incurred after the goods reached at the Indian ports. Here the question here is, the revenue contended that demurrage charges paid by the assessee are includable in the assessable value. So the shipment has been hold and I am paying it is a demurrage, it's like a fine or penalty. So that has been included in the assessable value, whether it is right or it should not be chargeable. So the demurrage charges are incurred after the goods reached at Indian port. So it is a port post importation event. So we call it as a post importation event. So the apex court held the demurrage charge are not includable in the assessable value of imported goods. So whatever pre-importation charges, in short what we have seen previously, all those transactions, we call it as a pre-importation cost or the pre-importation charges. Those things only we generally consider as an for the purpose of calculating the assessable value. But here the demurrage charges is post importation. You have received the import and then you have been paid the demurrage. So in this particular case, you are not, this should not be considered in the assessable value. Then we have insurance charges. If the insurance charges given yes, then add to the FOB. If the insurance charges is not given, then you need to add manually 1.125%. Same like freight. If the freight is given in the problem, then you need to see whether it is air freight or ship. So if it is air freight, you have one more condition, whether it is greater than 20% of FOB. If it is more than 20% of FOB, then you should hold it with the 20% of FOB. If sea freight is given, directly add the sea freight. If not given, then you need to manually add 20% of FOB. So these are the basic things what needs to be considered while calculating the assessable value. What are the items which should not be considered. So then we have with the problems. With this one illustration 3 we will stop today's. Find out the assessable value of imported goods. We have cost of machine, transportation charges. This transport charges means what? By the exporter from his factory to the port for shipment. Then we have handling charges. Then we have buying commission, freight charges, exchange rate. So what is the cost of machine? 10,000. Then we have transport charges 500. Then handling charges we have 50. We are deriving 10,550 as FOB. Then we have buying commission paid by the importer. So we have already seen, if it is an buying commission paid to the importer agent, that should not be forming part of our assessable value. Then we have insurance, freight we have. So insurance, how we are going to calculate? Just we have seen, if insurance is given, consider the same. If insurance is not given, we need to add 1.125% on FOB. So we are going to add it manually. Then freight charges. Freight charges is already given in the problem, which is $1,000. So all we have considered, and now the final thing is assessable value. With this amount is in dollar. Now which US rate, that is exchange rate. Now in this particular problem it is only one exchange rate which is given 75. In some advanced problems, when we are going to see in next class, we will see which exchange rate to be considered. So here it is given only one, so we have directly considered 75 rupees. So assessable value, which is 8,75,000. On this we will be calculating the duty, and the importer has to pay duty on that amount. So I will stop. till here, and in tomorrow's class we will see some advanced of the same problem. So any doubt, please message me, or if I need to add something in our syllabus, or if I need to add some additional points, kindly let me know. So I will add it, and then we can continue in our subsequent classes. So actually, because of the technical some issues, I couldn't able to log in. So tomorrow I'll try to log in 6:30. So we will start tomorrow's session. And anything from your end, please let me know.
Thank you, madam.
Yeah, thank you, sir. Yeah.